Forex Focus brought to you by IG. Why the U.S. credit rating downgrade doesn't matter. Now, of course, it matters for the particulars of the U.S. political engine and everything else. Of course, Biden had to come out and make a statement on this and everything else. It can matter for that. In terms of markets, what we talk about, we'll see how much it did matter in just a second. We're going to go through some really interesting charts over the last 24 hours around this news cycle of Fitch downgrading the U.S. rating to AA plus from AAA. And you can see this is a considerable fall from the highest credit quality to very high credit quality. Of course, I'm being facetious. A lot of people will tell you that the S&P, a different credit rating service, downgraded the U.S. in 2011 from AAA to AA plus, and the stock market and everything else has been able to chug along fine since then. So this is what it technically means. This is what we're dealing with. The Fitch people quoted as saying that the recent butting up against the debt ceiling here in the U.S. and not solving that until, really some of the final days that they could without potentially defaulting, that was a big piece for them. And the fact that the U.S. historically over the last decade or so, whenever that debt ceiling has come into question, have had a lot of political battles and really waited till the last days. And it seemed like we got as close to default as ever recently. That caused them to move us down from AAA, AA plus. Now, let's get into what really, matters for the traders out there. How did the market respond to this? Well, the knee-jerk reaction was a sell-off in dollars, as you might imagine. The U.S. is no longer AAA; they're AA plus. Well, I've got less of a reason to be holding dollars and to be long those U.S. interest rates if they're not as strong as Germany or some of the parts of the Eurozone or other regions internationally. All of that being said, this is an interesting looking chart right there. You can see, and thankfully Forex markets are, open 24/5. So this news coming out around 4 p.m. Central, 5 p.m. Eastern, coinciding with when futures are closed for an hour. And obviously the stock market is closed. You can see this move, 40 pips higher on the news. Now that equates to, though, less than half a penny in the euro US dollar exchange rate. This equates to, approximately a rally from $1.09 and 8 cents, 109.80, up to $1.10 and 2 cents, 110.20. So on the face of things, 40 pips, it's something. It's at the end of the day, relatively inside move. If you were to say, the euro dollar moved 40 pips today, that's, kind of per usual action. And now here's the move again highlighted over the course of what was the 24-hour period or so leading up until about noon today. And you can see that same 109.80 to 110.20, that 40 pip rally. And then you see about 100 pip sell-off to the lows, and obviously it's not encapsulating the afternoon part of today, but this is all to say U.S. dollar was able to recapture those losses throughout the rest of the night and the U.S. session to follow this downgrade and then some. And you might even point out what was going on right at the start of the U.S. session, early morning in the U.S., because that's a considerable fall in euro and rise in dollar in the region that's now highlighted. And that was a second tier employment data point that came out at 8:15 this morning Eastern time, where you see the euro fall considerably and the U.S. dollar make back a lot of that ground and then some. And pushed to the lows there at 109.20. It was ADP employment, and it came in a lot stronger than expected, pushing traders to potentially think that, oh man, U.S. employment is still higher than expected. U.S. inflation is maybe still stickier, higher than expected, and U.S. interest rates might climb even further. This U.S. region relative to the euro area, relative to the Australian dollar got hit pretty hard today. Relative to a lot of regions, the U.S. might still be humming along stronger than everyone else. And quickly discarded this downgrade news because, again, theoretically, you'd expect on the face of things a U.S. downgrade to lead to U.S. dollar depreciation. Didn't even get that in the 24-hour period afterwards. And here, just to highlight as well the interest rate action off of this and the stock market action, both Treasury prices and stocks moved lower in both these parts of the last 24 hours. So I don't want to make it seem like nothing came out of this. But you look at the fact that the news comes out around 5 p.m. Eastern, and from 5 to midnight Eastern, 10-year futures are down 2 ticks, and NASDAQ futures are down $80, which is, something. And then you have the number that comes out today at 8:15 Eastern. And so I'm looking at the 8 to 10 o'clock, and 10 years are down 5 times as much, and NASDAQ futures are down $100. And so again, does this credit rating downgrade matter to some people, some part of our economic organism, maybe outside of financial markets and what traders are, trading and looking at? Yeah, of course it matters to some extent. But I mean, even in the 24-hour period that followed this news, did it matter as much as a second-tier employment data point? I mean, the numbers can tell you that for me here, and it'll be really interesting to see how they digest this further. We have non-farm payrolls coming up very soon from the U.S. And these stories all developing, but at least in the short term, markets not caring too much about this credit rating downgrade.